Most people never start investing, and it's not because they don't have the money. It's because of two fears. What if I lose it all? And I don't even know where to start or how any of this actually works. So here's the truth. You don't need thousands of dollars, a finance degree, or to be good at math. What you need is a clear, simple plan and a real understanding of how this works. And that's exactly what we'll break down over the next 15 minutes. So let's get started.
First, the big question, why bother investing at all? Simple. Right now, if your money is just sitting in a bank account, it's quietly losing value every single year. That's inflation. Prices climb over time, and if your money isn't growing, it's actually shrinking. Here's what that looks like. Take $1,000 and leave it under your mattress for 10 years. Thanks to inflation, that same $1,000 would only buy you what about $700 gets you today. You didn't lose the cash. You lost almost a third of its power by doing literally nothing. Now flip it. If you'd put that same $1,000 into a basic S&P 500 index fund back in 2016, think of it as a bundle of America's biggest companies, it'd be worth over $4,500 today. Same $1,000, two completely different endings. One shrinks, the other multiplies. That's the real cost of waiting. Every year you don't invest isn't just a year with no gains, it's a year your money loses ground.
Now, the most powerful thing in investing isn't picking the perfect stock. It's time. Let me show you with two people, Anna and Ben. Anna starts at 25. She puts in $200 a month, then stops completely at 35. 10 years, done. Ben starts later at 35, but he keeps going all the way to 65. That's 30 years, 3 times longer than Anna. So who comes out ahead? Anna, the one who invested for just 10 years because she started first. That's compounding. Your returns start earning their own returns, and time does the heavy lifting. Starting early beats starting big, every time. Which is why the best time to start was years ago. The second best time is right now. One last myth to kill. Investing is only for rich people. Maybe that was true decades ago. Not today. You can start with 10 or 20 bucks. Most brokers dropped their minimums entirely. You don't need to be rich to invest. Investing is how regular people get wealthy in the first place. Okay, before you put a single dollar into the market, there's something most beginners skip, and skipping it is exactly how people get burned. Investing isn't step 1, it's step 3. Here's what comes first. First, your safety net. Before you invest anything, you want 3 to 6 months of expenses saved up, just sitting in a regular account, boring and untouched. Why? Because life happens. Your car dies, you lose your job, something breaks. If all your money is locked in the market, you're forced to sell at the worst possible moment, usually at a loss, just to cover the basics. The safety net is what lets you invest calmly, without panic. It's not optional, it's the foundation. Second, kill your high-interest debt first. Think credit cards. If your card is charging you 20% a year, paying it off is basically a guaranteed 20% return, and no investment can promise you that. So clearing the expensive debt first literally beats investing. Wipe it out, then start building.
Third, make it automatic. This is the one that actually separates people who build wealth from people who don't. Pick an amount you can invest every month without wrecking your budget. Maybe it's $50, maybe it's $500, whatever's realistic for you. Then set it on autopilot so it invests itself every month without you thinking about it. Small amounts going in consistently on repeat, that beats waiting around trying to invest one big perfect lump sum. Consistency is the cheat code here. So, safety net, no toxic debt, and a monthly amount running on autopilot. Get those 3 down and you've built a foundation most people never bother with. And by the way, if you're not sure whether you're actually ready to invest yet, I made a checklist that walks you through exactly that. You can go through it in about 2 minutes and see where you stand. The link's in the description if you want it. All right, foundation set. Let's talk strategy.
All right, you've got the foundation. Now the big question everyone gets wrong. What kind of investor are you actually going to be? And let's clear up the biggest mix-up right away. Investing versus trading. They are not the same thing. Trading is buying and selling constantly, trying to time the market, chasing quick wins off every little price move. It looks exciting on social media. Here's the part they don't show you. Study after study finds that around 90% of active traders lose money. 9 out of 10. That's not investing. That's gambling with extra steps. Investing is the opposite. You buy solid stuff and you hold it for years, even decades. It's slow, it's kind of boring, and boring is exactly why it works. So for basically everyone starting out, long-term investing wins. Don't try to beat the market, just ride it.
Next thing to figure out, your risk tolerance. Basically, how much of a roller coaster can you actually stomach? And here's the thing you have to understand about the market. It moves in cycles. It goes up, then it drops, then it climbs again, over and over. Crashes and dips are completely normal. They happen regularly, sometimes every couple of years, sometimes more often. And every single time, people freak out like it's the end of the world. But here's the part that actually matters. Zoom out, and after every single crash in history, the market didn't just recover. It went on to hit new highs, higher than before. The dips are temporary. The overall direction, over the long run, is up. And that right there is how you make money in long-term investing. You sit through the dips and let the long-term climb do its thing. So once you get that, this question gets easy. If your portfolio dropped 20% next month, would you panic and sell everything? Or stay calm, knowing that's just part of the ride?
And this is where your age is a huge advantage. If you're young, time is on your side. You can handle more ups and downs because you've got years, decades for the market to do its cycle and keep climbing. That usually means you can lean more aggressive, more into stocks. The older you get and the closer you are to actually needing the money, the more you dial the risk down and play it safer. Time is literally what lets you take risk. Last piece, know your why. What's this money actually for? Retirement in 30 years? A house in 10? Just building long-term wealth so you've got options later? Get clear on that because your goal shapes everything. How much risk you take, what you buy, how long you stay in. I just want to make money isn't a plan. A real goal is what keeps you from panic selling the second things get shaky. So, think long-term, not fast. Match the risk to your age and know what you're actually investing for. Lock those in and you're already ahead of most people who just wing it.
Okay, this is the part you've been waiting for. Where does the money actually go? Let's break down your main options fast. First, individual stocks. When you buy a stock, you're buying a tiny piece of one company. Apple, Nike, whatever. If the company does well, your slice goes up. If it tanks, so do you. And let's be real, this is where the big money can happen. Pick the right company at the right time, and a single stock can blow past what any index fund will ever do for you. That's the upside, and it's a real one. This is how some people build serious wealth. But, and this is a big but, that upside comes with a price tag. Individual stocks are volatile. They swing hard, up one day, down the next, and you can't just buy and forget. You'd have to actually keep an eye on them, stay on top of the news, watch how the company's doing. It's not a check it in 2 weeks kind of deal. It's way more hands-on. Miss the wrong moment, and that big win turns into a big loss.
So that's the trade-off. Higher potential reward, but more risk, more stress, and way more of your attention. For some people, that's worth it, even fun. For most beginners, it's a fast track to panic selling. So if you go this route, just go in with your eyes wide open. Now, here's the calmer and honestly smarter path for most people starting out. ETFs and index funds. Sounds technical, but the idea is dead simple. Instead of betting on one company, you buy a basket that holds hundreds of them at once. The classic example is an S&P 500 index fund. One purchase and you instantly own a piece of the 500 biggest companies in America. Apple, Microsoft, Amazon, all of them, bundled together. If a few companies have a bad year, the others balance it out. That's called diversification, and it's basically the closest thing investing has to a free lunch. So if one company goes under, you barely feel it. It's a tiny slice of a huge basket. And the best part? You're not glued to your screen every day. You're not stressing over one company's earnings.
You just own the whole market and let it grow. Way less drama.
Real quick, if some of these words are starting to blur together, ETF, index, diversification, all that, I've got you. I made a whole playlist called Investing Terms A to Z, where each term gets explained in about 60 seconds. Plain English, no fluff. It's linked in the description, so if a term ever trips you up, that's your cheat sheet. Two more you'll hear about. Bonds. Think of them as the calm, stable option. Lower risk, lower reward. They cushion your portfolio when stocks get wild. And you'll also hear about gold and crypto. Quick take, they can have a place someday, but as a total beginner, they're extra. Start simple, get comfortable, then explore later if you want. So if you take one thing from this whole section, make it this. You don't need to pick the perfect stock. A boring, broad index fund does the heavy lifting for you. Simple beats clever. Before we keep going, if any of this has been useful, do me a favor and tap that like button.
Before we keep going, if any of this has been useful, do me a favor and tap that like button. It genuinely helps the channel reach more people who are just starting out, same as
I'm
you.
getting into the mistakes that quietly cost beginners thousands of dollars. The exact stuff you'll want to avoid before you put in a single dollar. You don't want to miss that. Okay, let's keep going.
All right, enough theory. Let's get practical. How do you actually start, like today? Step one, you need a broker. A broker is just the app or platform that lets you buy and sell investments. Think of it as your doorway into the market. No broker, no investing. This is where everyone begins. In the US, the big, well-known names people usually start with are Fidelity, Charles Schwab, Robinhood, and Vanguard. That's not me telling you which to pick, just so you know the kind of names we're talking about and where to start looking. But here's the thing nobody tells beginners. Not all brokers are the same, and a few things actually matter when you pick one. First, fees. Almost every broker these days charges zero commission on the actual trade, which sounds amazing, but don't let that fool you. No broker is truly free. They make money somewhere, whether it's hidden fees, the spread, or the interest on your cash. So always check the fine print. Small fees look tiny, but over years of investing, they quietly eat into your returns.
Second, what can you actually buy on it? Not every broker gives you access to everything. Some have a huge selection. Tons of stocks, ETFs, international markets. Others are more limited. So before you commit, make sure it actually offers the stuff you want, like that S&P 500 index fund we talked about. Sounds obvious, but people get stuck here all the time. Third, is it safe and properly protected? This is a big one. Look for a broker that's regulated and licensed, not some random app you've never heard of. And check for investor protection. In the US, for example, that's something called SIPC, which covers your account up to $500,000 if the broker itself goes under. Important detail though, that protects you if the broker collapses. It does not protect you from your investments losing value. Two totally different things. Don't mix them up. And fourth, is it actually easy to use? Especially starting out, a clean, beginner-friendly app makes the whole thing way less intimidating.
Now, quick note on crypto. Most regular brokers will let you buy some crypto too, right alongside your stocks. But if crypto is really your thing, if that's what you're here for, you're better off on a dedicated crypto exchange, like Coinbase or Kraken. They focus only on crypto, so you get more coins, more features, and better tools than a general broker bolting it on the side. Just remember what we said. Crypto's a wild ride, so tread carefully. Okay, you picked your broker. What's next? You open an account. And yeah, they'll ask you to verify who you are. That's completely normal. Every legit platform does it. You'll need some basic ID and a few personal details. Some platforms even ask for a quick video call or a video selfie to confirm it's really you. Don't let that throw you off. That's actually a good sign the platform's serious about security.
Once you're approved, the broker opens an account for you, your brokerage account. That's where you send your money, and that's where you buy your investments from. But here's a heads up most beginners don't see coming. Moving money from your bank to that account can take a couple of days to clear. So if you're planning to buy something, transfer your money in ahead of time. Otherwise, you're sitting there waiting, and the price could move up or down while you wait. And a little tip. Some people like to keep a bit of cash already sitting in their account so they can buy right away whenever they're ready, without waiting on a transfer. Totally up to you, but it's good to know it's an option. Then,
the moment it all comes together. Money's in, you find that index fund, you hit buy. That's it. That's the whole thing. You're officially an investor. The scary part was never the buying. It was just getting to this point. And now you're here.
Okay, now let's get to the question you actually came here for. Forget the vague advice about just start early and invest regularly. Let's talk real numbers. How much money do you actually need to invest, say, every month? And what can that realistically turn into in 10 or even 30 years? That's the part that matters. And that's exactly why everyone keeps telling you to start as early as possible, because of what you're about to see. So let's stop talking theory and look at the actual math. Let's keep it simple. Say you invest $100 a month. That's it. Skip a couple of takeout orders, basically. And let's use the stock market's long-term average of about 10% a year. After 10 years, you've put in $12,000 of your own money, but your account around $20,000. So that extra $8,000, that's not you. That's your money making money. Okay, but that's just 10 years. Now brace yourself, because what happens over 30 years is going to genuinely shock you.
Same boring $100 a month. Nothing fancy. Over 30 years, you've personally put in $36,000 total. Your account? Sitting at over $226,000. Let that land. You put in $36,000, you walk away with $226,000. That's almost $190,000 that appeared out of nowhere, just from staying in the game. That's the magic. And here's the key. Nothing changed except time. Same 100 a month the entire way. The early years feel slow, almost pointless, but the back end explodes. That's why every year you wait is a year you literally can't get back. Now, quick reality check, so I'm not lying to you. The market doesn't hand you a clean 10% every year. Some years are up, some are down. This is the long-term average, not a promise. But over decades, this is the kind of thing that quietly turns regular people into millionaires. Not luck, not timing, just time plus consistency.
Okay, this is the part I promised. The mistakes that quietly drain beginners' accounts. Dodge these and you're already ahead of most people. Let's go fast. Mistake 1, trying to time the market, waiting for the perfect moment to buy. Here's the truth. Nobody, not even the pros, can call the top or the bottom. The perfect moment doesn't exist. Time in the market beats timing the market every single time. Just start. Mistake 2, panic selling. The market dips, everyone freaks, they dump everything at a loss. Don't be that person. Remember what we said. Dips are normal. The market recovers. Selling in a panic just locks in the loss. Zoom out and breathe. Mistake 3, putting everything into one hot stock. Your buddy swears this one coin or meme stock is going to the moon, so you go all in. Bad idea. If it crashes, you're wiped out. That's not investing, that's a bet. Spread it out. Stay diversified. Mistake 4, checking your portfolio every single day. This one feels harmless, but it'll drive you insane. You'll see every tiny dip and want to react. Long-term investing is set it and let it grow. Checking daily just tempts you into dumb moves. Log off. Leave your life. And mistake 5, waiting forever to start. Reading, researching, getting ready for months and never actually buying anything. Look, you don't need to know everything to begin. You just need to start small and learn as you go. The biggest mistake isn't picking the wrong fund. It's never starting at all.
All right, so if you want to go deeper, let me point you somewhere. There are 3 books that basically every investor recommends, and for good reason. The Psychology of Money by Morgan Housel. That one's about why we make irrational decisions with money, and it's honestly a great read even if you're not into finance. Then, The Simple Path to Wealth by J.L. Collins, which lays out the index fund approach in the most straightforward way possible. And A Random Walk Down Wall Street by Burton Malkiel, a classic, a bit denser, but it'll make you way more confident about how markets actually work. Grab one, not all 3. Start with whichever sounds most like your vibe. And don't feel like you have to read anything before you begin. Books just make you sharper along the way.
So let's bring it home.
You know why investing matters, what to do before you start, what to buy, and what mistakes to dodge. That's the whole plan, and you're already ahead of everyone still saying, I'll start someday. So don't let this be another video you watched and forgot. Pick one thing and do it this week. Open the account, set up the transfer, buy your first index fund. Now, you're probably thinking, okay, but what does a full portfolio actually look like? That's a whole video on its own. If this one does well, I'll break it down next. What goes in a long-term portfolio? How much of each? And how to build something you can leave alone for decades. Want that? Hit like and let me know. Subscribe so you don't miss it. See you in the next one.